Warren Buffett is one of the biggest names and among the richest people in the world today. He is consistently ranked high on the Forbes list of billionaires. As of 2022, Buffett is worth $125 billion. Buffett is probably best known for being one of the world's most successful investors, with a portfolio and investment strategy that has reached mythical proportions. So how does he do it, and what are his tips for success? Let's find out in this video. Value investing principles. Warren Buffett was always interested in money since a young age. He began his career as an investment salesperson in the early 1950s, and by 1956, he formed Buffett Associates. Less than 10 years later, in 1965, he was already in control of Berkshire Hathaway. In case you're wondering, Buffett follows the Benjamin Graham School of Value Investing. Value investing is the principle where you look for securities with prices that are unjustifiably low based on their intrinsic worth. There isn't a universally accepted way to determine intrinsic worth, but it's most often estimated by analyzing a company's fundamentals. Like bargain hunters, the value investor searches for stocks believed to be undervalued by the market, or stocks that are valuable but not recognized by the majority of other buyers. Buffett takes this value investing approach to another level. Many value investors do not support the efficient market hypothesis, or EMH. This theory suggests that stocks always trade at their fair value, which makes it harder for investors to either buy stocks that are undervalued or sell them at inflated prices. They do trust that the market will eventually start to favor those quality stocks that were, for a time, undervalued. Now, Buffett isn't concerned with supply and demand intricacies of the stock market. In fact, he's not really concerned with the activities of the stock market at all. This is the implication in his famous paraphrase of a Benjamin Graham quote: "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Buffett takes this approach at investing in a particular company. He looks at each company as a whole, and he chooses stocks solely based on their overall potential as a company. Holding these stocks as a long-term play, Buffett doesn't seek capital gain, but ownership in quality companies extremely capable of generating earnings. When Buffett invests in a company, he isn't concerned with whether the market will eventually recognize its worth. He is concerned with how well that company can make money as a business. Buffett's methodology. Buffett takes a look at 6 points before investing in a company. It's believed these points have helped him build a strong portfolio. Company performance. Buffett believes a stockholder's return on investment, or ROE, is a good indication to look at in company performance. ROE reveals the rate at which shareholders earn income on their shares. Buffett always looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. Company debt. The debt-to-equity ratio is another key characteristic Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowing money. Profit margins. A company's profitability depends not only on having a good profit margin, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates the company is executing its business well, but increasing margins mean management has been extremely efficient and successful at controlling expenses. A public company. Buffett considers only those companies that have been around for at least 10 years. As a result, most of the technology companies that have had their initial public offering in the past decade wouldn't get on Buffett's radar. He said he doesn't understand the mechanics behind many of today's technology companies, and only invests in a business that he fully understands. This is also one of the most important criteria for value investing. Commodity reliance. You might initially think of this question as a radical approach to narrowing down a company. Buffett, however, sees this question as an important one. He tends to shy away, but not always, from companies whose products are indistinguishable from those of competitors and those that rely solely on commodities such as oil and gas. If the company does not offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Buffett calls a company's economic moat, or competitive advantage. The wider the moat, the tougher it is for a competitor to gain market share. Is it cheap? Finally, this is the kicker. Finding companies that meet the other 5 criteria is one thing, but determining whether they are undervalued is the most difficult part of value investing, and it's Buffett's most important skill. To check this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals, including earnings, revenues, and assets. and a company's intrinsic value is usually higher and more complicated than its liquidation value, which is what a company would be worth if it were broken up and sold today. The liquidation value doesn't include intangibles such as the value of a brand name, which is not directly stated on the financial statements. Once Buffett determines the intrinsic value of the company as a whole, he compares it to the current market capitalization, the current total worth, or price. Now, what are Buffett's tips for the current times where stocks are down and performing worse than ever? While many investors saving for retirement may be wondering what to do in such a tumultuous market, Warren Buffett has said the answer is simple: try not to worry too much about it. I would tell investors, don't watch the market closely, Buffett told CNBC in 2016 during a period of wild market fluctuations. The Oracle of Omaha added that investors who buy good companies over time will see results 10, 20, and 30 years down the road. If they're trying to buy and sell stocks, they're not going to have very good results, he said. The money is made in investing by owning good companies for long periods of time. That's what people should do with stocks. Many experts, including Buffett, also recommend buying index funds, which are automatically diversified and hold every stock in an index. The S&P 500, for example, includes big-name American companies like Apple and Amazon. Just like Buffett, the late legendary investor Jack Bogle also recommended a buy-and-hold strategy. He previously told CNBC that buying stocks and holding them was the best way to invest because your emotions will defeat you totally if you try to sell your holdings to avoid losses and get back in afterwards. Stay the course, Bogle said in 2018. Don't let these changes in the market, even the big ones like the financial crisis, change your mind, and never, never, never be in or out of the market. Always be in at a certain level. For most investors, trying to react to market trends is likely to backfire, financial experts tell CNBC Make It. It's better to wait out the market's ups and downs. If you've got a diversified portfolio, if you're just buying some index funds and you've got a long enough time horizon, it might be best just to ride these roller coasters, says Ashton Lawrence, a certified financial planner and partner at Goldfinch Wealth Management. Investors who sell when markets are down may actually end up derailing their long-term plans, says Sean M. Pearson, a financial advisor at Ameriprise Financial. Markets don't settle down, they settle up, he says. By the time the news looks a bit better, the market has already recovered. And if you miss the recovery, there's a very, very good chance you're going to make it harder to hit your financial goals. Instead, most investors might want to ignore their 401k accounts instead of checking them every day, Pearson says. I've been a professional investor for over 20 years. I haven't logged into my 401k site since the beginning of this slide, he says. For a lot of people, not looking at this might be the best way to kind of help them sleep at night. That's some wonderful piece of advice from the big names, and we agree with them quite a lot. Well guys, that's all for today's video. Hope you enjoyed this one. Thanks for watching.